Welcome back to eCampus. We're going to continue to learn about monetary policy. So here we're going to dive into the traditional types of monetary policy tools. So the ones especially still used today, but especially used before 2007. Okay, the new ones emerged then, and we're going to talk about why. The main one is done by the Federal Open Market Committee. So it's done by called as Federal Open Market Operations. Okay, it's done through the meetings of this committee every 6 weeks, so 8 times a year. Okay, where the board of governors plus all the presidents of the regional feds, they all come in and they discuss policy. They talk about what should be done, discuss whether the interest rate should be adjusted or not, whether the money supply should be adjusted or not, of course. So they discuss. Not all of them vote, okay, just 12 vote. The board of governors always vote, and then 5 more presidents vote, okay, from the regional feds. But the New York is always one of them, and the other ones rotate. So you can see it's pretty democratic between them. It's majority vote wins, and if they tie, then that's when the chairman steps in and he makes the final decision. Okay, but the main idea here, this is done to the purchase and sale of U.S. Treasury bonds, in which is a transaction between the central bank and commercial banks. Okay, so the idea is that if they meet through in the Federal Open Market Committee and decides to engage in expansionary monetary policy, in other words, they think the economy should grow right now, they need help grow, it needs help growing, then engage into open market operations of purchasing treasury bonds. Okay, the idea behind this, and I'm going to show in a graph, is that as they purchase bonds from banks, they get bonds in exchange, and the banks are getting reserves. Those reserves are cash that are not earning any interest. So then eventually that bank decides to loan that money out, which leads to more loans, more consumption, investment, thus economic growth due to the adjustments in aggregate demand. Okay. The idea is the reverse when we talk about contractionary policy. So in this case, it would be, hey, the economy is growing too fast, we need to pump the brakes. And we'll discuss some of the situations why they would want to do that. Okay. But the idea here is that in this case, they would be trying to sell. They would sell treasury bonds to those commercial banks. Eddie, what do you mean they would? The commercial banks don't have an option? No, it's the regulator. It's like if the government tells you have to pay taxes, you have to pay taxes. So when they tell you that they're going to engage in open market operations, whether it's a purchase or sale, the banks just have to deal with it. Okay, now you're going to see how technically this is not supposed to impact the solvency of banks, and that should be clear in future slides. Okay, but the idea of the sale of treasury bonds is the opposite. Now, if they're selling treasury bonds to those banks are now keeping treasury bonds, right, which still earns some interest, but it's a very, very safe investment. And in exchange, they're giving back reserves to the central bank. Since they have less reserves, that means there's less money available for loans. The cost of loans go up. Since the cost of loans is higher, people tend to make less loans, borrow less money. And if that's the case, it lowers the economic activity by decreasing aggregate demand. Okay, all this is going to be seen through slides, so don't worry about it. Okay, but that's the idea. Another name that you might see people talk about is in terms of expansionary policy, also called loose money policy. Okay, and in terms of contractionary policy, it's also called tight money. So you can see here is going to be a lot connected with the availability of money in the economy. Okay, so let's walk through what actually happens in terms of how the balance sheet of a bank is impacted, given that there is expansionary policy and then contractionary policy. Okay, so let's say in this case, suppose there's a bank A, which we're going to be analyzing. Okay, and it has $460 million in assets, which includes reserves, bonds, and loans, $400 million in liabilities. Okay, and which means a net worth of $60 million. Don't worry, I'm going to have a table like that with all that information in a second. Okay, and imagine here that there's open market operation. The Fed purchases $20 million in bonds from Bank A. So once again, because they're purchasing bonds, that means they're going to be taking bonds from the bank and giving reserves. So let's see how that actually works out, and I'll give you a little zoom here. Okay, so the initial situation here is that the bank has $40 million in reserves, $120 million in bonds, $300 million in loans, as you can see here. Okay, also, as you can see, maybe I shouldn't zoom out, it makes it a little bit harder. There you go. 10% is the reserve requirement, and you can see that they're holding $40 million, which is 10% of $400 million in deposits. Okay, so then the Federal Open Market Committee comes in and they decide to buy bonds from the banks by engaging expansionary policy. Okay, if that's the case, you can see here a drop in bonds from that bank and an increase in reserves, which is exactly the transaction we talked about in the previous slide. Okay, the bank doesn't have a choice about this, it's just going to happen. Oh, Eddie, but isn't this messing up with the bank's business? Not really, right? As you can see, the add of $20 million in reserves and the drop in $20 million in bonds, it still leaves the bank with the same net worth. So the solvency of the bank is the same at that point. It's not impacting the solvency and the equity. Okay, so then you can see, well, the bank hold more reserves now than they need. They need just to hold $40 million because they still have $400 million in deposits. Yeah, that's exactly right. So they're going to find a better use for that, for the extra reserves that they're holding, right? And the way they'll do that is they'll probably give out more loans because they're a higher earner, that you can earn more income than you would from the bonds, right? So given they'll decide to give out more loans, that will increase aggregate demand in the economy. So that's the idea, but you still can see that at the end of this transaction, the net worth was not impacted. Okay, so Eddie, where do they find money to buy those stuff? They make it. That's the power of the Federal Reserve. They can print money. Now, back in the day, maybe there was a lot of printing money, physical money. But as you know, we're living in an economy where there's a lot of technology, that a lot of digital money, right? Checking accounts, savings accounts, and so on. And they can just digitally print money by pressing a button, which then updates the balance sheet of those banks. Okay, so the Federal Reserve is that powerful, and I think that's very important to understand, and that's why they have such a powerful impact on the economy. Okay, so let's walk to the contractionary policy now, and then we can do the same thing we did. So the same idea, the same bank. We're going to see the situation in a second, but now instead of purchasing $20 million in bonds, they actually going to sell $20 million in bonds to those banks, to those commercial banks. Okay, so let's see what happens here. Now, important to say here that of course, bank A is going to then reduce the money circulation because the money multiplier, which then contract economic activity. So this is going to come from the idea that, hey, they're not going to be able to give as many loans out because they have less reserves. Okay, so let's see how this is going to work out. So in this case, this is the same initial situation, $460 million in terms of assets and $400 million in terms of liabilities, which leaves the $60 million in terms of net worth. Okay, so what's the idea here? In this case, let's say that instead of $20 million, there's $30 million in terms of selling of bonds to those commercial banks. Okay, and you can see here that the $30 million would say that they're going to be forced to buy $30 million of bonds, which will come straight up from reserves, right? And in exchange, they will have more bonds. So the assets have not changed. Okay, you can see here net worth still stays the same. Well, but Eddie, now they don't meet the requirements of 10%, right? They need to have $40 million in reserves, but they now have only 10. Well, exactly. They're going to have to raise their level of reserves. They're going to have to do that by giving out less loans and gathering more reserves. Okay, so you can see that the adjustment of the bank could be they're going to lower the amount of loans that they give out so they can then increase the amount of reserves that they have. Okay, so that way, the bank would still keep the same net worth after the contractionary policy is put in place, okay? But it would be impacting economic activity because now, as you can see, the bank would have less money to loan out because they have to still keep the minimum reserve requirement, okay? So that's the idea. We're gonna walk through that connects with the aggregate demand and aggregate supply model again in a little bit. Okay, but the main idea is, Eddie, why would we ever try to stop the economy? Well, if you've been to my classes throughout the semester, we have talked about overproduction all semester long, the idea of borrowing consumption from the future, which eventually means we have to pay that back, right? Now, the hope is that when we borrow from the future, we can use that money in a very productive way to compensate, not only to pay the principal, plus also pay the interest. So be so productive that you can profit over the overall cost for that borrowing. Okay, so in the 2000s, for example, with the dot-com bubble, a lot of people didn't understand how the internet would work, right? And a lot of people just started investing in those internet companies that were not even that good yet. There were maybe people in the basement that just got the company just started and they're asking for investors, right? So that idea would be, hey, people are over-investing because they're too confident in economic activity. That can lead to bubbles. And when we have bubbles, we have overproduction, overvaluation of assets that are actually not in that price. And once those asset drops, as we've seen on the money in banking, unexpected large drop in assets leads banks to have trouble. Okay, so that's the idea here. So we would try to pump the brakes on an economy that is growing too much and investing too much. Okay, if you remember, the economy go through business cycles. We want to make sure that the economy doesn't go through a large recession, but also doesn't go through a large boom, because that fluctuation is definitely important to be controlled so we can stay close to our efficient level of production, our GDP, optimal GDP level, which is the potential GDP curve. Okay, so the Fed really focuses on monitoring asset prices to avoid the formation of asset bubbles, and it can do that by using contractionary policy. Okay, so the next videos we're going to focus on how to discuss other types of monetary policies as well. So stay tuned.